the course curriculum of valuation exam is so vast. It is so vast. I felt that the course curriculum is much bigger than the course curriculum of chartered accountancy course or the company secretary's course or cost accountancy course or MBA program also. It's so vast. And the best part is that on the entire course curriculum, you are tested in just 2 hours. In just 2 hours. And,
Yeah.
and you know, that is the challenge that you have to face in passing this exam. Sometime, you know, whenever we have an opportunity, we will share. As a matter of fact, there are a lot of videos of mine available on YouTube where I did few sessions for many organizations on how to prepare and pass the insolvency exam, how to prepare and pass the evaluation exam, and that's where I have shared a lot of tips as to how should you prepare the strategy to prepare and do prepare, and also when you are sitting in front of computer for 2 hours, how should you handle those 2 hours. I have shared all those tips. So maybe in case if we get an opportunity, of course I would be very happy to share those tips with you. But otherwise, you can go to my YouTube channel, and there are about 380 videos on different topics of valuation, which I am sure you can take the benefit of. Right. So coming to the yield to maturity, what is yield to maturity? Now let me tell you, yield to maturity does not mean the return that you will earn on the security. Yield to maturity will mean the rate, and please pay attention, the rate at which the present value of future cash flows will be equal to the outflow on the investment of that security. In other words, YTM is the rate at which NPV becomes zero. And when I say this, I'm sure you will recollect this definition of YPM that I'm telling you, that YPM is the rate at which the present value of future cash flows becomes same as the investment amount, or by default NPV becomes zero. I'm sure you must have heard this definition also in the context of internal rate of return. So what is internal rate of return? Internal rate of return is the rate at which the NPV becomes zero on a project. Which means what? Which means YTM is same as IRR. Please pay attention, because thing that I am discussing with you, based on my experience, I can tell you it is very difficult to realize this point through self-study in a short time. You will get it. Definitely you will get it, but it might take some time. And therefore, if you pay attention, it will be much faster. So when you are taking a decision about CapEx, what do? You try and find out what is the IRR of a project. And then what do? Then you compare that IRR of the project with your cost of capital. Meaning what? Meaning your cost of capital, or the cost of capital of your business, let's say, is 15%. You find out the IRR of the project that you plan to undertake, it comes 20%. You simply take a decision and go for that project. And why you go for that project? Because this project is not only covering your cost of capital, but over and above the cost of capital, it is giving you 5% more. And that is why you take that decision. Just imagine your cost of capital was 15% and your IRR of the project is coming 14%. Will you accept this project? You will not accept this project. You will simply reject it. And why will you reject it? Because the IRR of this project is less than your cost of capital. That means if you implement this project, you will be paying more by way of cost of capital than the return that you will earn from this project, and therefore you will be bleeding, and one day your business will close down, and that is why you will not accept it. Same is the case for the mutual funds, for the pension funds, for the private equity funds, for the venture capital fund, for all the wealth manager, for all the investment manager, for all the funds manager all over the world. Same is the question. And what is the question? The question is, all of them have their own cost of capital. All of them have their own cost of capital. Any investment, they have a cost of capital. That means what? I'm sure you can very easily understand it now. That means what? That means any investment they make in any security, return on that security has to be more than their cost of capital. More than their cost of capital. So in case of a project, what you will do? You will find out the IRR. In case of a fixed income security, you will do the same thing. You will do the same thing, follow the same thing, but what you will find out also the same thing. The only difference is, there you call it IRR and here you call it YTM. YTM is yield to maturity.
Right.
Now meaning what? Meaning any investment that you make as a fund manager, as a wealth manager of a mutual fund, pension fund, equity fund, venture capital fund, any kind of fund, any investment that you make in that capacity, in any security, what you have to ensure? You have to ensure that the YTM of this investment is more than your cost of capital. If YTM of this investment is less than your cost of capital, that means your organization is going to bleed and one day your organization will close. So that is, friends, is YTM. I am sure the way I have tried to explain to you, I hope that you will never forget to whole of your life as to what is YTM. Number one, it is same as IRR. It is used for the same purpose as IRR. The only difference is IRR is used for the purpose of capexes. YTM is used for the purpose of same decisions of investment in investment securities. I hope that makes sense to all of you. So in case if you have a doubt, any question, please ask me, else we will move forward to the next question.